Good morning and welcome to our Business Buyers Funding webinar with special guest Tim Isaacson from Kiemera Corporate Finance. Tim, hello. Would you please introduce yourself and cover off your professional background?
Yeah, certainly. Good morning, everyone. Good morning, Andrew. So I have been a banker for the last 30 years. Jobs in the bank, head of new business UK for Barclays. I did quite a long stretch in underwriting and credit writing. And apart from that, in 2005, I formed a company called Kiemera, and I've been broking ever since. So we structure finance on behalf of people who are looking to refinance or looking to rebank or anything to do with commercial finance, really.
Good, thank you. So today we will be exploring the current funding markets, the government-backed finance scheme, and also what support is currently available for first-time buyers and existing operators who are looking to expand or acquire their first business. A number of attendees have already submitted questions ahead of today's event, and these questions have been built into the discussion topics. Some questions are of a similar nature and have been pooled into one topic. If you would like to ask a question, then please submit your question in the box on your screen, and I will endeavour to ask your question as we proceed through the webinar. Now, turning on to our first topic, Tim, please would you cover off the pre-COVID funding market in 2020 and explain how the current crisis has impacted decisions by funders?
Yeah, certainly. Okay. So 2020 looked to start to be a really positive year. We saw an uplift in the number of applications. We saw an uplift in the number of inquiries that we had, and that's generally because for the last couple of years we've been held back by political uncertainty and also with the Brexit scenario. So once we got those out of the way, we actually thought, hey, great, we can now be positive and now actually start moving forward. I think currently in our pipeline in our company, and there's only 2 of us that are currently working in our company. That's not because we've been furloughed or anything. That's our company. We've got a pipeline of 43 million over 42 deals. Those deals currently are hibernating, so they're sanctioned, they're moving forward, they're committed by the banks, but at various stages, solicitors not working in their offices or valuers not going out has caused a little bit of a delay. So the banks, and we're still working, so we are still getting sanctions, we are still seeing business plans coming in, and we're still writing. It's a little bit different for us because we tend to like to meet all of our clients, so we'll travel, go and see the client, but we're doing more and more stuff like this, and also communicating on the phone and on email. But it doesn't stop us from writing the business plans and submitting to the banks. The main differences is inconsistency. Right now, we have a lot of inconsistency within the market because this COVID-19 has come along and is absolutely decimated the productivity of the banks. They're currently now all looking after their own clients, trying to sort out their, bounce back loans and CBILS, which I'm sure we'll cover off in a minute. But what that does mean, it just tends to take a little bit longer. We've not had a turn down, so we've not been declined. We've noticed no difference in bank appetite. It's just going to take longer.
So what you're saying then is that the banks are open to receive applications and to give indicative opinions of lending. It's just that they're not able at present to take that through to completion.
Okay, so there's various stages to when you put an application into a bank. First, you've got to gather the information and you've got to build a business plan. Now, every business and every person is different. So we're not like a mortgage lender where we'll do a tick box application. It's a 3-bed semi and I own 40 grand. Can I get an 80 grand mortgage? Business isn't like that, and also people aren't like that. Everyone has different financial needs. Everyone has different financial advantages or disadvantages. What we have to do is we build the business plan and we answer the questions that the bank's underwriting team would ask before they've asked them. That way, we don't get involved in appeals. If we have an appeal, we haven't done our job properly. But yes, since COVID-19, we are still getting sanctions through on various sectors, and we'll get the sanction. So it's not an indicative terms. It's not we think we can do this. This is a credit backed. We will support you subject to the following conditions. Generally, those conditions will be valuation of either the business or the property and legal work.
Okay. So when we first entered the sort of COVID period and lockdown was on the horizon, Rishi Sunak made a big play of a loan scheme called the CBILS scheme, which, you know, I believe for SMEs is up to about £5 million of lending. A huge, I think the total pot, including the corporate one, was announced at 330 billion. Could you provide everybody with just a quick overview of the CBILS scheme, but also your experience of dealing with lenders in relation to CBILS?
Okay, yeah, certainly. So CBILS stands for Corona Business Interruption Loan Scheme. It's anything from £50,000 up to 5 million. It's open to all British businesses, but businesses that have turnover of less than 45 million. You must be able to demonstrate that you've been affected by COVID-19, fairly simple in this day and age at the moment, and you must be able to evidence affordability. Now that is a little bit of a strange one, because most businesses have been told you've got to calm down, you've got to stop working, you've got to sit at home with a dog. The issue that you've got there is, how do you prove affordability? Now, affordability for me is going back through when pre-COVID-19 was about, looking at the performance of the business. If it was a good business then, it will still be a good business when we come out of COVID-19. The other option that you've got, and the other condition, is your business had to be trading on the 1st of March 2020, and it couldn't have been in financial difficulty as of the 31st of December 2019. 6-year term, fixed or variable rates. This was quite interesting. When it first came out, the government was saying, well, we'll give you these CBILS loans, and then after a year, we'll tell you what the interest rate's going to be. Madness. That has now changed. You do get your interest rate now when you apply for your loan. For the first 12 months, it's interest only, and that interest is paid by the government. You have 5 further years then to repay your capital on a loan repayment on a monthly basis. There are no early repayment fees if you want to make lump sum repayments to the CBILS, and the government back 80% of the exposure.
Okay, thank you. Now, obviously, if we parcel off the corporate side, where we don't really have the figures published on that, one of the biggest frustrations, and we'll come on to bounce back loan later on, is obviously the 330 billion was announced, and the ease by which access to this was presented in a very slick manner. A few days ago, I think that the latest stats were something like £6-7 billion of lending, and actually I think bounce back loans might have overtaken them. Why do you think that the money is not filtering through as intended by Rishi Sunak to SMEs?
Yeah, I mean, my experience, and one of my businesses has actually applied and successfully got its CBIL. The issue that you have is it's inconsistent. There is so much inconsistency in sanctioning with the underwriters right now. Businesses and banks at the present time, they've pulled a lot more people in, but you'll see that a number of the banks have their operations for sanctioning, etc., outside of the country. And those countries could be in a worse lockdown than what we are. So frustration in getting paperwork to clients, frustration in inconsistency within that CBILS loan sector. You'll find that some bankers want a cash flow forecast. And you kind of like argue with them, look, I wouldn't be coming to you if I'm only eligible if I've been affected by COVID-19. So therefore, why do you want a cash flow forecast? You know, it really does get a little bit tedious and a little bit ridiculous. But because of the factors of huge amounts of requirement, the banks have been caught with their pants down. They didn't realise that the amount of need from their own clients was going to come into the arena. That they've been caught with their pants down, and paperwork coming from other parts of the world is ridiculous, and that's what's all causing the issues. Saying that, when we got our paperwork through, they'd actually got the wrong figures on it and the wrong term on it, so that had to go back. So I can't tell you. I can't tell you. It's a wonderful position to be in. The banks are doing the best they can, and all credit to the government as well. But it's quite a painful experience.
Do you think one of the lessons, and by the way, this question could be broader for the UK as a whole, but do you think one of the lessons for the banks is actually that drive to outsource abroad the processing side of the business in events like this, which are true global pandemics, works against them, and potentially they might see more of the operating processes being brought back into the UK?
Yeah, I think the banks, and being an ex-banker and working for two of the big four guys, I see too much focus on cost cutting and not enough on running their own business. If the banks actually did what they did when they were profitable, really truly profitable operations back in the 80s and 90s, they did everything within the UK, and therefore, time to lend money was a lot slicker. It was a lot quicker. I understand now that bank managers don't have the authority to sit there and say, yes, we'll do this deal, shake hands and walk out the door, and the paperwork's being sorted out by the PA or the secretary. Them days are gone, which is unfortunate. What we're in now is we're in workflow, and so what we're seeing is that COVID-19 has come along and affected the whole wide world at once. Unfortunately, some of the banks have operations in India. That's on complete lockdown, and all their paperwork and all their systems that they've built over the years to cost cut are now under huge amounts of pressure because they can't get the money out the door because they can't get the paperwork out to the clients. Madness.
Okay. Question that's just come in on this topic from Martin. Can a CBILS loan be used to actually buy another company?
You've got to be in business. The proposal has to be viable, it has to be viable, and the lender, were it not for COVID-19, they need to, if they think it's a good idea to do something, they'll do it. I don't know quite if it's in the scheme of things to go and buy a business. Potentially, if you're expanding and creating jobs, the scheme covers that. So yeah, you just have to be a little bit, probably a little bit sly on how you convey what you're looking to do with your COVID.
Is there a closing date for CBILS applications?
I think it was September, but all the information can be found on the British Bank website.
Yeah. Do you have the details for that?
Yeah, sure. It's www.british-business-bank.co.uk.
Good, well done, well remembered. Now, obviously, with some of the negative publicity that was thrown at the government, they decided to then go back to the magic money tree and create something called the bounce back loan, which I'm not sure we'll ever see anything like this again. So do you want to just give an overview for anyone who doesn't understand bounce back loans? What are they? Who can apply for them, and how easy are they to obtain?
Oh my goodness, this is very unique. I've never seen anything in 30 years, and again, because Kiemera has been affected by COVID-19, we've been able to apply for one of these. Not that I need the money, to be fair. What I wanted to do is test the system. So I wanted to see what it was like and how to make it work. But the bounce back loan, anything from £2,000 to £50,000, it cannot exceed, though, 25% of your turnover. You can't have applied for a CBILS loan, so you can't have a CBILS loan. You had to be trading from the 1st of March 2020. You weren't in financial difficulty at the 31st of December 2019. The interest rate is 2.5% fixed. So let me just go 2.5% fixed. Now that's a very attractive, decent interest rate if you were borrowing £1 million. So 50 grand, 2.5% fixed on a term of 6 years, with the first year being interest only, and the government paying the first year's interest, and you don't have to give any security, it's a little bit like Christmas.
It is. And I'm just going to come on to another question from Derek that's just come in. And I believe the answer is yes, because I've even seen Martin Lewis advising business owners to refinance existing debt using the bounce back loan because of the rate. So Derek's asked, can the bounce back loan be used to pay all creditors, including directors' loans?
Yeah, I'm not sure whether that's in the spirit of things, but yeah, I mean, my view is if you've got asset finance on a van and it's costing you 12%, and you've got £10,000 outstanding, and it's on the term of 3 or 4 years, why wouldn't you pay that off and get 2.5% and increase the term? For me, yeah, you have to look at things in the spirit, but the application on this loan is unbelievable. I think I answered 9 questions. I didn't have to put in any figures, and I got sanctioned within 48 hours. And you know, good stuff for Lloyds Bank here. Lloyds Bank come along and put the money in my bank account within 48 hours. So yeah, you can use it to pay off more expensive debt.
Okay.
But directors' loans, probably not in the spirit.
Okay. So moving forwards now, and this is something we've seen with our pipeline transactions. Obviously, there's still the appetite, but now lenders are creating something called COVID-19 clauses. So would you give us an overview of what they are and how they are satisfied, please? Okay,
so it's quite simple, because we are all expecting the transactions that would usually take 3 or 4 months from agreeing a purchase to a completion. That's going to move quite substantially out, because the banks are sitting there and saying, okay, look, we'll sanction the deal, no problem. We'll even get a valuation done, but between the valuation and completion, we are going to want to see that your business has returned to its profit levels and income levels pre-COVID-19 for 3 months. So when you look at that, if a transaction was taking 4 months, those 3 months are going to increase it to 7 months. So potentially you're now seeing that transactions will take a longer period. Now, not all banks have adopted this, and some banks have come in and said, well, you can't commit to a business for 3 months until you've got those 3 months figures, and we will want to see them and check them. And others have been more vague. Again, because of the scenario and how this is all working, it's constantly changing, and bankers are looking at, they have an obligation to look after their shareholders, firstly, themselves and their own reserves, but also they need to be responsible lenders. And certainly what they're looking to do and what they're worried about is lending money where they've sanctioned deals, the valuers have gone out and valued on these particular transactions, and then the business hasn't come back to its previous glory pre-COVID-19. Now that could be for a number of reasons. If it's a children's nursery, it could be that you've had the children simply not return to the nursery. If it's a care home, you could have a number of residents that have been taken ill by COVID-19 or worse die, and again issues are appearing like that. So the whole idea is to make sure it's safe for you as a buyer to complete that transaction, or what may happen is you may see things go back to the negotiation table.
Okay. Interesting. Be interesting to see how these develop as we go through the summer period. The reliance, the requirement for staff to be redeployed to extending mortgages, to CBILS, to bounce back starts to come back, and they reposition themselves where they need to be. So moving on to a slightly broader debate now. One question that was submitted was around challenger banks, really, because post the Great Recession, the push was on to introduce more competition in the lending markets, and we're over 10 years through that now. So the market should have matured to a level. Could you give people an overview of who the challenger banks generally are and whether they're lending at the moment?
Okay, so the challenger banks were supposed to be this knight charging on his white horse over the hill, coming to save everybody in business to make some lending. My experience and the experience of Kiemera and our guys is very, very simple. You've got people like Aldermore, Metro, Atom Bank, all have come along with a big kind of like, look, come and try us. We will help you. In reality, these guys have come along into the market and they've set up their own bank. Their cash reserves are not as strong as the big four, so therefore they are not able to offer the interest rates as the top four do. So the first thing, yes, they are doing lending. They are very, very rigid in their underwriting. So it's more like applying for a residential mortgage or a buy-to-let mortgage. And to be fair to the challenger banks, they are absolutely nailing it on property investment. So if you've got a commercial property or a residential property that you want to kind of like fund up, borrow money against, they are much more aggressive than what you'll get in the high street banks. However, trading bits gone.
Sorry, I was just going to say, obviously they don't have the experience and the personnel of the big six. Does it take longer to draw down via a challenger bank?
Yeah, okay. So what I was going to come on and say was that, in my experience, that because the underwriting is so rigid and the expertise doesn't seem to be there, as I kind of like mentioned earlier, when we write a business plan, no person is exactly the same. So you have to explain and you have to get your main points across to your lender, to your underwriter, why you should be doing this deal. Most of the applications that you complete for a challenger bank, there's no room to explain that. They don't want your business plan. Atom Bank didn't want our business plan. They wanted us to fill in a 2-page form to lend £1 million, and that's what they were going to make their decision on. It doesn't work like that. It's fundamentally that doesn't give an underwriter the ability to make an assessment on that business and on that individual, whether they are a good risk to that bank. So the first thing that you've got is you have almost like a mortgage application style lending application, which in business doesn't work. In residential mortgage terms it does, but in business it doesn't, for the reasons I've already explained. And then everything seems to be paid up front. So my experience is that you pay your valuations before you've actually been given a credit-backed answer. Some of that is quite dangerous for clients, and clients need to be aware of that. Most of them don't have their own legal team, so they employ firms of solicitors to do their work. The client pays for that. So the challenger banks were a brilliant idea. To be honest, I'm still to be convinced, and I'm still doing 90% of our applications with high street banks and getting them all through.
Interesting, very interesting. So if we move on now to some questions which I've pulled together around first-time buyers, what advice would you give first-time buyers in the current climate, and are they still able to secure finance?
Yeah, certainly. I mean, first-time buyers probably have the hardest task right now, because they've not been, if they're first-time buyers, they've not been in business, so their track record is always in question. So the big thing that we have to do is the CV of a client is really, really important. Their experience in the sector. It's kind of very difficult for a bank to get comfortable with Ted the milkman wanting to come along and be Ted the children's day nursery owner. What skill sets does he have? What training? What experience does he have? However, if Ted has been a teacher, then Ted has got some transferable skill sets and experience in working with children. So therefore, the CV and transferable skill sets are really, really important. We generally find that the banks lend on three things, which is experience, they want a deposit, so they want some skin in the game, and so they want some security. So if all three of those can be ticked, at various levels of loan to values, we'll see that transactions can go through.
Okay, interesting. And in terms of criteria then, is there much difference, aside from track record, is there much difference for an underwriting criteria between a first-time buyer and an existing operator?
Yeah, so an existing operator has the ability to show off their accounts and to show how well they've done and how well they've performed in that sector. That's a big plus. Of course, when you haven't run a business, you can't do that. You rely on that CV. So what you'll find, the difference between the first-time buyers and the existing operators is that two things will change. Loan to values for the first-time buyer may actually be dipped a little bit. So they may lend less money because they see it as a greater risk. And they may see that interest rates for first-time buyers are a little bit higher because they're a greater risk. Whereas if you're an existing company, if you're an existing business, you're seeing higher loan to values and lower interest rates. But they're the sort of things, if you've got a good broker, they're the sort of things that they argue and they sit there and fight the cause for the client.
Good. All right. Thank you for that. So I'm going to switch now into some live questions that we've got. So first question's from David. Is cash flow lending for acquisition financing still available? Have the multiples stayed the same, 2 to 3 for manufacturing businesses?
Yeah, so cash flow lending can be done. It's something, again, the high street have shied away from since the banking crisis, really. More of the specialised banks, so you're looking outside of the high street on stuff like that, more of the specialised banks will do cash flow lending. You'll pay the price for it. It will be expensive. But generally speaking, if it gets you across the line and it's used as a tool out of a toolbox at that particular time, and then potentially in 2 or 3 years' time, you've changed your business or made it stronger, you can then change the way you fund that business through a cheaper option.
Okay. Question from Tunji. As a business buyer, all the required documents have been submitted to the bank prior to COVID. What should we be doing? Can we arrange a valuation?
Okay, so again, valuations are happening. So I've got cases right here, right now, that are having valuations done. There are certain companies that won't. For example, at the moment, Barclays will not do any valuations via their company eServe on residential mortgages. So if, for example, you're buying a business and you're securing that debt by having a charge on your house or an investment property, then the issue that you've got is that Barclays can't go out and do a valuation on it right here, right now, unless you use a commercial valuer and tell the bank, well, I'm happy to pay a commercial valuation, which, but to be fair, no, valuations are happening. What you're finding is that the bank will be able to arrange those, but the valuer will be making sure that when he goes out, he's probably going out to an absolutely empty building, factory, whatever, and therefore that may happen first thing in the morning, last thing at night, depending on what your business and whether you're still operating out of there. But yes, very much so. That's what's happening in the world with valuations and moving things
so
forward.
We've had 3 or 4 questions on valuations, which I'll pool into one. I guess what people really want to know is, are valuations going to be affected by the COVID crisis in terms of the value that the bank valuers place on a business?
That's a great question.
Get your crystal ball out.
I was going to say I should be on my yacht in Monaco if I know the answer to this. Look, all I can say is my experience in the past, when there was a financial crisis back in 2008 and 9, you found that the bank's valuers were absolutely reducing the values of properties. For 2 reasons. Number one is their PI cover. So what they were worried about is in years to come, if this particular deal was going wrong, the bank would attack them on their PI cover. That was well documented, and that did happen. So that's the first point. So I can't see right here, right now, bank valuers being aggressive with their valuations. So what I've done on a number of my clients that have already got their sanctions, we're already going forward. If it's a trading business, we're tending to hibernate that deal until we've come out of uncertainty with this lockdown. Because have your valuation done at your peril. Yes, potentially you may be able to have a valuation done, and the valuer may come down and say, well, it's not worth what you thought it was pre-COVID-19 because of COVID-19, and reduce it. Now, there's two things that does. The first thing it does is the bank will lend you less. And the second thing it does is it upsets the vendor, because you've done a deal with a vendor at that particular time, and potentially the deal that you were going to do may fall apart because you're saying that the business isn't worth that because of where we are currently in the climate. Now, in 3 months, 2 months, 1 month's time, that may change. So it is a buyer beware. Properties, I think, are easier because as far as I can see, we live on an island. There are properties and there are comparables every time. But how at the moment do you value a children's nursery?
I think one of the important things in our Redwoods, Dowling, Kerr, Kings and Bruce & Co brand are working with our clients, especially those that are in deal at the moment. And for us, it's about the reason why you're in a deal is because a buyer came along, could assess the business from the past few years' track record, and it fit with their acquisition strategy. COVID's come out of nowhere, nobody's fault. It's not a strategic decision, it's something that's affected. Now, it's about how you come out of this. So Children's Day Nursery, for example, what's your marketing strategy? What are your children numbers like for September? How quickly can that buyer and that valuer see that you will return to the levels you were at pre-COVID? And I think the operators who are switched on have got that. As an example, this week we've done a deal, a multi-million-pound deal for a group of Children's Day Nurseries. And that has been massively hit by the COVID outbreak, but the vendor's got good demonstrable plan for coming out of it. There's a slight 3-4 month delay on the completion timescales to make sure they deliver it, and everybody's got confidence. People will still get older and need healthcare. People will still have children that need childcare, and business will go on. And actually, if you speak to some of the residential guys who've maybe been open a day or two, they've had a significant kicker for viewings, which are now obviously taking place in their arena. So I hope that covers off the sort of value evaluation side. Next question, quite a technical question this, Tim. I have relocated to the UK on a Tier 1 entrepreneur visa in Q3 at the end of 2019. I got stuck due to the Brexit election and now COVID. We are supposed to be opening a preschool / nursery. I've started the infrastructure work. Am I eligible for a CBIL?
Well, if you remember what I said earlier on, you have to be trading on the 1st of March 2020. So if you've not started trading, you're not eligible for a CBILS. However, you should be eligible for finance. I can't go into specifics because I don't know all the information. But if anybody is quite happy to kind of like give me a call or email me, and I'll happily talk them through where they are in their own positions and see if we can come up with some ideas. But generally speaking, if you're putting money into a project, you've got experience, you've got security, and we can demonstrate with a robust forecast that the business can service any debt, then it doesn't have to be a CBILS. It can be a normal loan.
Yeah. Okay. Thanks for that. Another question from Martin. What is the appetite for lending against account receivables accounts to raise money for acquisition?
Oh, okay. Good question. When he says account receivables, are we saying income? Are we saying
I'd say income.
Yeah, okay. So if you have income streams coming through, whether that's rents or whether that's from trading, then potentially you have an opportunity to fund against that. I'm guessing if you're looking at invoicing clients and you want to speed up being paid, there's things like invoice discounting and factoring that you can utilise to speed up your cash flow and borrow money against your debtors. If, however, it's I've got all this income, I want to borrow some money. Well, turnover is vanity, profit is sanity for us bankers. So you may have lots of turnover, but what's your overheads like? What's your profitability like? And that's what will deem the levels of lending that you'll be able to achieve.
Okay, thanks. There's a question coming from Kwame, which I'll cover off. Do you think using owners' sellers' equity or finance with the intention of refinancing at a later date to secure the deal to be a viable option? We're starting to see a little bit more traction at the moment with some slight vendor loans where buyers are then looking to, say, refinance later down the line. But I think, and Tim, correct me if I'm wrong, it depends on the appetite of the banks when you look at a lending application as to whether you can get everything you need or whether you need to try and squeeze the vendor for just that little bit of a vendor loan. Anything to add to that, Tim?
Well, yeah, I mean, it's well known that you can defer a certain amount of money, and to be fair, that every opportunity that you have to make the deal work, both vendor and purchaser, is something that needs to be done. So my view is if everybody communicates and they come up to the worst thing is to get so far down the line and the deal falls apart for 25 grand or 100 grand or whatever the amounts it's going to be. The thing is, if you work together, you can generally get it across the line. And remember, banks need to lend money. If they don't lend money, they won't make money, and therefore they won't be there anymore. Now they have an obligation to their shareholders to make money and pay dividends to us as individuals, to pension funds, etc. So, deals will have to be done and lending will have to be done. It just may change the way it's done.
Okay. I'm just going to put a quick poll on screen now, just in case. We've had a few people who've made contact about having a private discussion off webinar with Tim. So if you are one of those people, if you just click yes to the poll that's on screen. Next question for you, Tim, is can existing healthcare operators get 100% finance?
Again, that's a really good question. Again, I don't want to go into specifics because it depends how you run your business, and this is really, really important. If you're geared to the hilt on your first business and you're making losses, then do you realistically think that the bank's going to lend you money to do number two? The answer to that is probably not. So if you run your business well, you've made profits, and you have equity within your business, yes is the answer. Potentially, yeah. You can obtain 100% worth of funding.
Okay. And then I've got a nursery one, albeit it's broader than day nurseries, from somebody who said, do I have an option to buy a nursery on a standalone basis, but you could put a business instead of day nursery, and then integrate later into a company?
Yeah, you can. That's not a problem. The way the businesses are like a journey. So you may start off as a sole trader, or you may start off as a partnership. I don't want to get into accountancy advice because I'm not an accountant, but there'll be certain trigger points that will suggest that you are better off being in a limited company than you would be in a partnership or a sole trader. But the thing to remember, as the business grows, then yes, it can adapt to a limited company, but you will find you will have to go back to your bank, and that bank will then need to lend you the money in the limited company instead of your personal name. Now, that may incur costs, and that if you've got a fantastic interest rate that you've managed to negotiate and you're going back to the market, you might not be able to get that interest rate. So surely it's always better to have a vision of where you see your business in 3 or 5 years' time and make sure you've planned for that. So if you think that your business is going to be in a limited company format in 3 or 5 years' time, my suggestion is do it now, because the cost of refinancing that may outweigh the tax advantages that you get.
Okay. One interesting point, we've had a question that predominantly has been answered, but there's a section of the question which I'm slightly confused at, because I think the answer is no. Is there a radius applicable to funding from where you live? So, for example, what the individual's asked is, can first-time buyers get finance on care homes which are more than 100 miles from where they live?
Okay, well, there's no reason why they can't. But again, specifics, this does depend on certain things. If you have experience within the sector, let's say you were managing a care home before you wanted to buy your own care home, you have experience in the sector. You know certain amounts of legal obligations, you know the mechanics of how that business works. Secondly, you've got to have a good management team there. So, for example, if you've got a manager there that's been there for 10 years, the CQC reports on that care home, for example, are all good, there has never been a problem with that, and that manager is staying on, and there is, a good solid staff structure behind that manager, then it doesn't matter whether you're sitting next door to that business or you're 100 miles away. You have all the technology, as we're proving today, that you can communicate quite easily and see how that business is running. So personally, yeah, I don't see why not. But again, I want specifics. We'd have to see the strength of the business and the individual. But on a carte blanche, it doesn't matter if they're 200 miles away.
Okay, question which I presume is to assist with business acquisition. What would banks lend against residential mortgage property where you live? So in other words, can you refinance your existing house to help support a business acquisition?
Okay, so most mortgage lenders don't like you to refinance or release equity out of your house to finance a business. They see that as a little bit risky. I can't tell you that would be a welcome application. You may need to think on how you communicate to your own mortgage company. The one thing I would always say though, banks write down the value of your property, and to make the maths really easy, if you've got a house that is worth £100,000 and you have got a mortgage of £10,000. So you believe you've got £90,000 of equity, the 100 to the 10. What the bank does, because they see it as a worst case scenario, is they will take 30% off of the value of your house. So it's gone from 100,000 to 70,000. So the equity that you have is 60,000, 10,000 mortgage to 70. They see that security value as 60,000, not 90. However, mortgage lenders don't do that. They tend to work on the value of the home. So I'm not going to say any more, but
Okay.
there are many ways to skin a cat.
Okay, thanks for that, Tim. One final question now that's come in for myself. Andrew, are you getting sellers willing to do deals with little cash down day one and agreeing deferred payments, which may be a higher price for their business? Interesting question, and one we're getting more and more, and very difficult to answer, solely because every vendor's situation and every business circumstance is different. We are doing deferred deals, but it's the majority of the money is day one, and the deferment is to support the sale price, but over quite short periods. So if the question motive is, can I pay £1 for £1 million business and pay them on the drip over 10 years, the answer is no. But if you have got a sensible proposition, and we are dealing with a vendor who has their own motives for sale, then actually our negotiators are working along those lines at the moment. So what I would suggest there, Martin, is you pick the phone up, have a conversation with one of our team, and I'm sure they will have a chat with you about where your thought process is, where your budget is, and give you some honest sort of supporting advice of whether or not you stand a chance. I think you've got to be careful. We don't want to be upsetting people and putting stupid offers in. but for a nominal 10-15% on a deferred basis, yes, you know, there is certainly appetite for that. So yes, 2 minutes overrun. Thank you very much for everyone for attending, and fantastic. Thank you very much, Tim. Brilliant webinar. Thanks for everything today. And thank you to the audience. And finally, Paul Miller, no, I won't be asking that question. Right, goodbye. Thank you. Until next time.
Thank you.